how does a firm start to manage their financial affairs? Fundamentals of Finance, Week 2. The first thing I want to go through again is there's a difference between financial reporting and accounting as opposed to financial statement analysis. Finance is about using numbers. Accounting is about creating numbers. So we assume that the firm has an accounting system and we're using information from that. Financial reporting provides financial information to enable users to make decisions. It includes financial statements and other types of reports. But now we get into making decisions, okay? And we use financial information to look at what we've done, to determine out where we're going, and to make decisions. Decisions to buy assets, sell assets, decision on pricing, decision on expansion, profitability, to look at a lot of different things, okay? So there is a difference, and I want to make sure we keep drawing that distinction. We're looking at using financial information. Now, we talked earlier also about financial sustainability. Okay, a firm needs to meet the needs of the various stakeholders they have. That means customers need to be satisfied, suppliers, employees, shareholders, debt holders, so that there is this long-term sustainability. Now, as part of that, the firm uses assets to create an income for products and services with the outcome that there is a profit. Now, in your first project, you looked at the company and you defined out what their products and services are. So that's the first step. Now, as we start looking at it, we need to ensure that the firm is profitable. So that starts with sales. And then the intent is to have that profit there. As we saw last time, the balance sheet and income statement. A balance sheet equals assets minus liabilities equals equity. Keep in mind the debits and equal the credits. Okay? Then there's the income statement. And the bottom line with that, no pun intended, oh no, revenue, sales, less cost equals income. And the goal is that you have that. The next thing, those are the two primary statements, but in managing a company, either internally or externally, the most important thing is cash. Okay? Cash is the lifeblood of every business. There's not a single business that can't operate without cash coming in and going out. Now, what I have done is I have created a small model company that we're going to spend the next few weeks looking at. So what I'm going to do is I am going to first give you some theory, some lecture stuff. Then I'm going to walk you through GENESEO Coffee Company. And then I'm going to walk through Destination XL. So the first thing about GENESEO Coffee Company you should know is they roast coffee beans and sell them to independent coffee shops and restaurants in upstate New York. They have competitors. Finger Lakes Coffee, Boulder Coffee, Coffee Connection. They recently earned the Best Robust Coffee Award at the International Conference in Vienna. The company operates in wonderful GENESEO, New York. They have a warehouse, and in the warehouse are 5 coffee roasters, one of which was purchased in 2015. The company sold 2.5 million pounds of coffee in 2015. The legal form of ownership is a corporation. Now, what I want to do is let's look at how the business runs. What's the process they go through? So the first thing they got to do, assuming they got the plant in place, is they need to buy coffee beans. Okay? After they buy the coffee beans, they need to do something with them. In this case, they roast them. Once they roast them, they need to sell them. Once they sell them, they need to get paid. Once you get paid, the cycle starts over. So what you have is they're business cycle, their operating cycle, starts with buying coffee beans, roasting them, selling them, and getting paid. Notice this operating cycle, if you will, doesn't include the plant and equipment. Nowhere do we see here buy roasters, buy a plant. So it's basically, this is the operating flow. Buy, roast, sell, get paid. Now, let's look at what happens at every step of the process. The first thing is they buy beans. Now, this may seem rather straightforward, but there's a couple of things that need to go into this. One is you need to identify suppliers. Then you're going to have to select a supplier. Then you're going to have to determine price, specifications. What kind of beans do you want? What's the quantity that you want? Now, when you're going to determine the quantity you want, you're going to have to anticipate future sales. So you're going to have to leave time for delivery of raw beans, okay? Because the raw beans are going to come from South America, they're going to come from Asia, from Africa, wherever, but there's time for delivery into our plant. Then there's the time for roasting and packaging. When it comes in, we have to roast it and then put it in bags. So we have to look at our desired inventory levels. So now you see this step here of buying beans is fairly complex when we get into it. Then, will they pay cash or credit? But all the way around this, the resources are needed. People have a cost because a person is going to do this. And depending on the terms, you may need cash to order. Okay? So in this case, we have activities occurring, and the resources that you need, people, maybe cash, but you also need this infrastructure of making sure you have an office that you then have telephone or cell phones and you have computers. Now, let's keep going. The next step in the process is roasting beans. So you have inventory and resources here. Well, you have raw beans that come in. When the beans come in, somebody has to receive them and organize them and put them in inventory. So then we have, next step is take the beans, put them in a roaster, which includes labor, utilities, bags, and other supplies. So we roast them. Then there's finished coffee. Value has been added. So we've taken these raw beans, we've done things to them, and now we have a finished product that we can sell. Okay? So keep that in mind. Also keep in mind, when are these costs expended? Okay, next thing, we need to sell the beans. So we need salespeople to interact with customers, to build relationships, secure the customer order. Once the order is received, it needs to be processed. We got to send them the right quantity. We need to ship it to them. So we need to have a delivery method in time. We need to bill the customer. Okay? Once we bill the customer, we move to the last step, getting paid. Terms with the customer. When will they pay you? Receive it and process the funds. You finally now have cash. Okay, so if this is the cycle, the operating cycle of the firm, what does that mean? Well, the business cycle takes time to operate. It doesn't happen instantaneously. Every step takes time. They need to follow a defined process. Doesn't happen instantly. And that means there's a time factor involved. The business process takes resources to operate it. Cash is needed to make the process work, because there is a time when cash is going out of the company but not coming in. The firm needs to provide that cash. Keeping in mind, debits equals credits. Okay? So if we're ordering, it's a debit to the expense, a credit to cash. So what we just looked at is referred to as the working capital cycle or the cash flow cycle. Okay? It's the operating cycle. Every single firm has these. Okay? And some of them, there's multiple steps, sub-steps going on here, and some of them may not be meaningful. Okay? If you are we'll come back to that. Okay? So now, let's put our operating cycle, our working capital cycle, with cash. So the first thing we can see here, buy coffee beans. That's cash out. To buy them and the cost of buying it. Okay? We keep going. Roasting the coffee beans. Cash is out again for the labor. Okay? For the bags, for the supplies, for the utilities. Sell the coffee beans. That's cash out. Finally, we get cash coming in. And the cycle starts. So now, think about this for a second. You need cash here, 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 and when you get to here, this is when the cash comes in. So if you're profitable, when you add up these costs here, and you finally get paid, hopefully there's more cash left over than the cash you paid out. That's how a company makes money. By making sure that the cash they get paid covers all of these costs. And it contributes to other costs of operating the firm, the long-term assets. Let's look at this in a little more detail from a debit versus credit perspective. Okay? You buy the beans. Okay? So at this point, you either pay cash or credit, pay later. So that would be debit, raw materials, inventory on the balance sheet, credit, cash or accounts payable. At some point in the future, they need to pay cash. And in that case, the cash would go out and accounts payable would go down. So cash goes out here. Okay? Roast the beans. Again, we use raw materials, labor, utilities. Cash needs to come out. So we're going to debit work in progress. We're going to credit raw materials because we're now taking them beans, adding value, and we're crediting cash or accrued expenses. Okay? So we're now creating a work in progress inventory. Then we sell the beans, and that's the cost of selling, including shipping. We're going to debit selling expenses, credit, this is the cost of the labor, and entry number 2 is we're going to debit accounts receivable, credit sales, and the final entry, debit cost of goods sold, and credit inventory. Now note we have this credit here, income statement, cost of sales, income statement. So this is really the recognition of the sale and the profit, but not always of the cash. The cash comes in at the end. So what does this all mean? Business and cash flow are critical. There's time, and it can be measured in days and in dollars. The faster the cycle time, the faster the cash moves. And cash is needed for a shorter period of time and can be redeployed faster. So the slower the cycle, you'll need more cash for a longer period of time. Let's go through that again because this is critical. So if you have a cycle time that moves fast, the cash is moving through the organization faster, generating cash profits faster. The slower the cycle, it's longer for those profits to turn into cash, and you may need more cash capital to make it work. Keep that in mind. The question then comes up is, can I compute the cycle time? Because if I can compute it, measure it based on financial data, then I can evaluate it Then I can quantify it, measure it, determine the cost of working capital, and if I have enough. Can I compute the cycle? Yes, you can. You can measure this cycle time in both dollars and in days. Once you compute it, you can evaluate it, and you can do two things with it. Then you can see how much working capital you need, if you have enough cash to run the cycle, but you can also identify opportunities for improvement. If part of the process is slow, perhaps you can speed it up, but you need to understand it. First, you measure. It's expressed in days, and it starts with the inventory conversion period. How long does it take to get from buy the beans to roast the beans? Then, accounts collection period. How long will it take to collect those funds once you sell it? Now, we don't always pay for everything up front. At times, we have accounts payable accrued expenses. This is other people's money that relates to the production. So that reduces our cycle time. And when we take inventory conversion period plus the accounts receivable collection period, less accounts payable, that will give us the cycle. Now, how do we do this? Well, we start with inventory conversion. How long does it take to process and sell? This is measured traditionally by inventory divided by cost of goods sold divided by 365. So inventory divided by cost of goods sold 365 is the inventory conversion period. The average collection period. How long does it take to convert an accounts receivable into cash? Well, we start with accounts receivable divided by sales divided by 365. The payables period, this is the length of time that suppliers give us to pay. That's accounts payable divided by cost of goods sold divided by 365. This will all be expressed in days, and we'll have the financial impact to go along with that. What I'm going to do now is we're going to take a look at GENESEO Coffee Company. We're going to look at their financial statements. After we look at their financial statements, we're going to go compute this cash conversion cycle. You can bring up GENESEO Coffee Company's Excel worksheet. It's posted in Module 2, and it will be updated every week to include more things. So the first thing I want to talk about, look in the bottom, it's tabs are financials, definitions, cash conversion cycle. That's what we're talking about now. So let's go back. I've created this so that it's fairly straightforward, and I built it so that you can see where the numbers come from. You have a balance sheet that looks like that. Destination Excel has one too. So we'll go through GENESEO Coffee Company. Then I'll switch over and walk you through the balance sheet of Destination so that you can look at yours in the same way. So the first thing we have here is the balance sheet. Okay? And it's labeled year, it's a point in time, 31 December 15, 31 December 14, and 13. So the first line we see is cash. We see 150, we see 80, and we see 50. So these are the cash balances they had at that point. When we go over to definitions and we look here, cash includes the cash they may have on hand in a drawer, what they have in checking accounts, savings accounts, and certificates of deposit. So that's what we would refer to as cash. The next category is accounts receivable, 460, 320, and 250. When we go over to the definition, accounts receivable include the amounts that are owed to us by customers for merchandise or services that they bought from us. As you can see, that within that, the company needs to have a credit policy. What are the terms that people are going to pay you on? When will we extend credit? When we won't. If somebody doesn't pay, what are the steps that we will engage in? So part of the financial function is to monitor those accounts receivable. The next thing we have is marketable securities. And we see 100,000, and that's what there. That can be, marketable securities are those things that they're not needed for working capital. They're not part of that cycle, but they're temporarily holding assets that aren't needed at the moment. They can be short or medium term, and they're for future use. They're not part of that cycle. Important thing to remember there. So we have some of them, and then we have inventory, and we can see that it's growing. Inventory includes supplies, the bags, raw materials, the coffee beans, work in progress, that is the beans that are in the roaster, and then there's the finished goods once we've roasted them and packaged them. So that's the inventory. And when you add them all up, that gives us the current assets of the company. Okay, so we got that right there is the current assets. The next category is property, plant, and equipment. These are things that benefit multiple periods. So first you define those things that are current, readily convertible into cash, and then longer term assets. And that can include equipment, land, buildings. Okay, these are investments, long-term acquisitions that benefit multiple periods. So the roasters aren't used within the operating cycle. They benefit many operating cycles. So when they're benefiting many operating cycles, that goes into property, plant, and equipment. We also will have, depending on the company, other things, intangibles, other assets that have a long life and are not used in the working capital cycle. Okay, so we come back, we got that. That gives us our total assets right here. Now we move on. Now these are the assets. Remember, assets less liabilities equals equity. When we take a look at what we have here, we have accounts payable and accrued expenses. Okay, accounts payable and accrued expenses, if we come over to the definitions, these are amounts that we owe for what we have purchased that is used in the process. So that would be the beans. If we haven't paid our taxes on coffee, supplies, and that's what we owe. Now, sometimes people will let us buy on credit. Other times will require cash. Sometimes you're offered a discount for paying early. Okay, so it might say 2% net 30, which essentially means that you can take a discount if you pay within 30 days. So you need to monitor that as well. So then we have debt. And as you can see here, I got long-term debt, and then I have the current portion of long-term debt. Now what that means is that this is the amount we owe for debt, the $700 and the $800. But of that, only $100,000 of it is due in the next year. These are the total debt is $800, but $100 is payable in the next year. So that has to be repaid. This is a longer term debt, meaning it's greater than 1 year. So when we look at long-term debt, just from a definitional perspective, there's a lot of different pieces of debt. We have bank debt that can be used for working capital, notes, lines of credit, discretionary, meaning that the bank can cut it off at any time. It's a fixed amount. Or what we call revolving lines of credit. And we'll get to more of this as we move on, but that's committed. That's oftentimes based on a formula that a bank will lend you a certain percentage of your accounts receivable or in. Then we have commercial paper. Commercial paper is corporate IOUs, and it's just borrowed, and it's a marketplace. Then we have bank debt for long-term assets, and that includes mortgages, other collateral, that might be a piece of equipment, or just unsecured. And that has a term, how long we're going to pay it back, interest rate, and don't forget that interest is tax deductible. That'll keep coming back. We then have bonds, which are mortgages, unsecured indentures. Some of them could be private, some could be public. Same thing. But a bond, the bond holder has a lien or has an interest in the assets of the company but doesn't share in the profit. So now we get into the shareholders' equity. So we start out with the total assets less the current liabilities less debt is shareholders' equity. So if you notice, if I take the 2,000,002, subtract out the 554 and the 700, what's left is 1,000,005. That's the equity. So assets less liabilities equals equity. And the equity has three components in our case right here. The first is they have common stock. This is the equity ownership in the company. And as you can see, there's 1,000 shares issued, $100 par value. Retained earnings, that's the amount of money that has not been returned to shareholders, is 505. They also have something called preferred stock. And that preferred stock is just that. It's an quasi-equity. However, it pays a fixed dividend rate, and this dividend rate is all the shareholder is entitled to. It generally provides for a higher yield or cost than does debt because the dividend paid or interest paid on it is not tax deductible. However, when you're looking if a company liquidates, you got to pay off the secured creditors, unsecured creditors, then you would pay off the preferred, and finally what would be left would go to the common shareholders. So we have our equity here, total equity. So if we add these three together, so if we start, let me just put this over here. So if we take this, and we're going to subtract minus liabilities, and that's our equity. And as you can see, that's our equity. So it matches. Debits equal credits, the Boyd rule. Let's take a look at their income statement and retained earnings. We can see that last year they sold $6 million worth of coffee. That's a lot of coffee. It cost them, their cost of goods sold was $4.8 million. So the cost of goods sold are the direct costs. That's the cost of the beans, the labor, the utilities, the supplies, etc. And when we take sales or revenue, less cost of goods sold, we get the gross profit or the gross margin. Okay? Then, subtracting from that is the general and administrative. These are the costs that aren't directly involved in producing the product. So that would include your legal expense, your marketing expense, your management expense. And then there's interest expense, and that's what we pay for the use and forbearance of money. That's the interest on our current portion of long-term debt and our long-term debt. That's what we're paying. That gives us income before taxes. You then compute taxes, and then we have something called the effective tax rate. Note that. So 312 times 30% is 93,600, and the net income is 218,400. However, since you have preferred stock, 30,000 comes off for dividends paid. Retained earnings at the beginning were 316 and end up at 505. So these are the earnings of the company that we haven't paid out. And this year, you can see that we paid out preferred dividends. Now we look at the cash flow statement, which I indicated was probably one of the best things that now that we've taken a brief look at the balance sheet and income statement, let's take a look at the cash conversion cycle. And here's the formula. It's inventory divided by cost of goods sold divided by 365. So here's the inventory. That came from our income statement balance sheet right here. Cost of goods sold came from our income statement right here. So now that we know that, we can take that, and when we divide it out, it's 57.03 days. So it takes 57 days, more or less, from the time we get the inventory, the coffee beans, to the time we deliver it to the customer. It takes 57 days. So now we know we also got the period of receivable from the time we ship the goods till the time we get paid. And that's accounts receivable divided by sales divided by 365. And we go directly to the financials. See, it's right up there for you. Financials, F6, C6. Okay, so we go from C6, which is right here, 460. Then we pick up the sales, which comes from the income statement, right there. We'd multiply it out, and it's 27.98 days. So it takes 85 days for this working capital cycle to go on. However, since we have accounts payable, meaning we owe trade people, are those that provide us with the beans and other things, have extended credit to us without interest. So again, we take the accounts payable, which comes from C15, C15, right there, 454, and we're going to then pick up the cost of goods sold. So it's the same number, so we bring it down, and we find out that it's about 34.57 days. So we take inventory conversion, 57, plus 85, less 34, gives us an inventory conversion cycle about 50.44 days. So this is the cycle time from buying the beans to getting paid. It takes about 50 days. So the company has to fund that amount. Okay, so that's the financials. This is the cash conversion cycle for GENESEO Coffee Company. What I've been trying to do is to keep each video module to between 30 and 45 minutes, so that if you want to go back, you can find things that'll be easier. And that's about the attention span that we have. I generally can't sit more than 30, 45 minutes anyways, so this is just an opportunity. What we're going to cover next in the next part of this section is working capital definitions.